Afternoon and welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the chief strategist here at Options Play. And today I have a topic for those of you that are equity investors. How to use long dated options to replace the stocks that you currently invest in or hold in your individual portfolios. Now, there may be a variety of reasons why you may want to replace your stock position with an options position, but I think the most common reason is usually leverage, the ability to trade a larger amount of notional value than the amount of capital that you actually have in your portfolio. So applying some leverage, but doing it in a way where you have limited amounts of risk. And that's really what options provide you with. So if you have any type of equity investment, whether you hold on to a stock for a few months or a few years, there are really option strategies that are suitable for these types of longer term investments. And, or maybe you want to invest in these stocks, but you are concerned about, a pullback or a larger market correction, and you want to protect yourself in that event. These are all the reasons why you may want to consider utilizing options instead of buying or shorting an individual stock. So today what we're going to do is we're going to explore long dated options. We're going to talk about when should you use them, what are the best practices, how do you select the appropriate expiration dates and strike prices for these longer dated options, and then talk a little bit about the tips and the pitfalls that do come with trading these longer dated options. So let's go ahead and get started. Before I do, just a quick disclaimer, what we're going to discuss here today is purely for educational purposes. It is not a recommendation or solicitation to buy or sell any specific securities. And for those of you that do not already have access to Options Play, which is the tool that we're going to be showing you here today to analyze these options, you can sign up for a free version that the Montreal Exchange has provided all Canadian residents with using the link here at the bottom of your screen. And I just posted that into the chat window for those of you that do not already have access to this free tool. It gives you access to the platform that I'm about to show you, bi-weekly options education webinars, just like the one you're on here today, a free options video library for you to learn how to trade options, and weekly cover call and short put reports all come free if you register with the link on the screen. So with that, let's go ahead and get started. Today we're going to go through a few different things, but first we're going to start with what are long dated options. They're really simple to understand, but we just want to define what long dated options mean. When should you actually go about using them? Very important topic because they're not suitable for all types of investments. They are suitable more so for more of the longer term investments or longer term bullish or bearish outlooks on an individual stock. And then once we understand the strategy, when should you use them, then we'll talk about what are the optimal expiration dates and strike prices that you should choose when you're trading these longer dated options. And then we'll talk about a few different things like certain tips with trading these, as well as a strategy called a Poormans cover call. And then what we'll do at the very end is we'll jump over to Options Play. I'll try to provide as many samples and examples as possible because I think that's the best way to learn, and show you, comparing a stock to a longer dated option and seeing how they perform next to each other so that you can make a decision yourself as to which strategy is best suited for you. And the goal here today is to make sure that you leave here today with a good sense for what long dated options are, whether they are suitable for you or not, and lastly, if they are, how to analyze them using Options Play. So that's what I want to make sure that everyone walks away with here today. So we're going to start off by talking about what are long dated options. Now, if you've ever learned about a call or a put, then you technically already know what a long dated option is. A long dated option is simply just a call or a put option that expires greater than 9 months from today. So that's it. There's no special contracts. There's nothing special about them per se, other than the fact that they expire a long time from now. Many of you that trade cover calls or cash secured puts, or even if you speculate on short-term swing movements on a stock, you're probably used to trading calls that are 1 month, 2 months, maybe 3 months out. But 9 months, that's a long time from now. So this is just referring to options that are longer dated in nature. And you can use calls when you have a bullish outlook on an underlying stock, and use puts when you have a bearish outlook on an individual stock. So if everyone understands what a call or a put is, please type yes into the chat window. If you do not know what a call or a put is, please type no into the chat window. Okay, look, a lot of yes. Great. Okay, it looks like everyone knows what a call or a put is. So if you know what a call or a put is, then you already know what a long dated option is. Now, call or a put provides you with two very distinct things. What we consider unlimited upside exposure for calls, meaning as the stock continues to move higher and higher, you make more and more money. But if the stock declines, you have limited amounts of losses to the downside. Same thing with puts. You have unlimited downside potential. Now, technically, this is limited to zero, but the stock needs to go all the way to zero. You have unlimited profit potential all the way down to zero. And if you are wrong and the stock rallies, you have limited downside risk on the individual stock. So that's the risk profile of a call or a put, meaning you can trade this directional view, and if you're right, you can make more and more money as long as the stock moves in the direction you expect it to. But if you're wrong on that direction, you have limited amounts of losses. And that's one of the key elements of why many people trade these options as opposed to buying a stock. So when we're buying a long dated option, a call option is a replacement for long stock. So if you're ever considering buying a stock and holding on to it for a while because you believe that the stock is going to appreciate in capital, that's when you want to consider using a long dated call as a replacement for that stock position. Now, to do so, you need to have a bullish outlook that's at least 2 to 3 months out, in my opinion. Meaning, if your bullish outlook is only for the next week, you should not trade a long dated option. You should trade a shorter dated option in that particular case. I highly recommend that you utilize this for longer dated views on your underlying stock. Lastly, this is also something that you should consider, but sometimes you might want to invest or buy a stock that is near overbought, meaning a stock that meets all-time highs. Maybe there's earnings coming out, or maybe a stock has already made a pretty strong rally, but you think that it can continue moving. And many times we see a lot of these stocks that are very strong momentum stocks, and what you get is this kind of parabolic move. So you still think it can move, but you're concerned as to how long it can move for. And this is really something that, is everyone having problems hearing me? Okay. 1 second. Is that better? Testing. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Okay, looks like that's a little better. Okay, sorry about that. So what I was saying is that, this is really for those of you that have a bullish outlook on an underlying stock that's at least 2 to 3 months out. And what you want to do is many times you might be in a position where the stock is maybe about to report earnings. So you're concerned about investing right before earnings, but you still want to get in because you think there's a chance the stock can continue moving higher. Maybe the stock is a little overbought or is at the end of an extended rally, but you think there's still momentum for this to move higher. And I think the current market conditions are suitable for this. We've had a very long bull market, but as much as things are slowing down, there's still some more room to the upside. So you want to participate in that, but you want to make sure you control your risk to the downside. That is an example of when you might want to consider buying a call option instead of buying the underlying stock. Now, for puts, this is really more so for when you need to hedge a stock or a portfolio of stocks. And the reason I say this is because generally, most of us do not have a long-term bearish view on a stock. Because most bearish views on stocks may be relatively shorter dated. So you might be better off trading shorter dated options. But if you do have a bearish outlook that you think is going to last greater than 1 to 2 months out, that's when you might want to buy puts or long dated put
on a stock that you own to protect some downside. Meaning if you think that the markets are going to correct, you think we're going to enter a recession, and you think the market's going to move lower for an extended period of time, that's when buying a put option may be suitable. So those are the scenarios that you'll generally find yourself in where you want to utilize either a long call or a long put, a longer dated call or put. So I think the best way to really look at this is going through an example. So if we have a bullish view on stock XYZ and the stock's currently trading at $100, and you think over the next year this stock is going to rally. And again, this is a relatively long dated view. This is not something where you think the stock's going to go from 100 to 103. This is a stock that you think is going to go from 100 to maybe 120, 130, long-term investment that you want to make in this individual stock. So as an equity investor, you would just simply buy the stock. So a trade like this, you might buy 100 shares of it at the current price at $100 a share. And what this provides you with is unlimited reward. So as long as the stock continues to move higher, you're going to make more and more money as long as it continues to move higher. And your max risk is the amount that you paid for the stock. So it's $100 a share is the most that you can risk. That's what happens if the stock goes all the way to zero. Conversely, you can buy an option for this. So let's say you buy a 1-year call option. Here, what I'm looking at is September 2020, and I'm going to buy an in-the-money call. So the current stock is at 100. I'm going to buy an $85 call. And let's say I pay $25 for that call option. Now, I'm going to come back a little later to talk about why I bought the in-the-money call, because that is an important piece. But I'm going to come back to that in a little bit. But when I buy this in-the-money call, and let's say I paid $25 for it, notice how I'm basically paying $25 a share as opposed to $100 a share. What that means is that I'm getting about a 4-to-1 leverage on the trade. I only have to put up 25% of the capital that would require to buy 100 shares of the stock. So instead of putting up $10,000 to buy 100 shares, I only have to put up $2,500 to buy the option. Now, what you'll notice is that with the option, I still get unlimited upside. So just like the stock, I get unlimited upside. And now my max risk is reduced from $100 a share to just $25 a share. So no matter what happens, even if the stock goes all the way down to zero, my risk is only $25 a share. So far, I've put up less capital to get into the trade. I have unlimited potential reward to the upside, and I've reduced my risk from $100 to $25. So the question is, why wouldn't I always trade a long-dated option? And the answer is the primary difference between the stock trade and the option trade is that on the stock trade, if the stock moves even higher by a penny, I start making money on this trade. Even if the stock is $101 1 year from today, I'll still make $1 a share. But when I buy a call option, I have to factor into my new break-even price, which is $85 plus the 25, which means my break-even price on this stock, on this strategy, is actually $110. So what that means is that over the next year, between now and expiration, on the expiration date, the stock actually needs to move 10% higher just for my strategy to break even. So basically, I need to believe that this stock is going to move 20, 25% before this strategy really makes a lot of sense. And that's the primary difference between buying a stock and buying a call option, is that one, as long as the stock moves a little bit, I start making money. And the other strategy, the stock needs to move a significant amount before the strategy starts making money at expiration. So I want to make sure everyone understands that concept and understands the difference between buying a stock and buying a call. And if you understand that difference, please type 1 into the chat window, just so I can make sure everyone understands the concept of the difference between buying a stock and buying a call option. Okay, great. Lots of ones. So to understand puts, it's really almost identical. We're just flipping this on a dime. So we have a $100 stock. Now we believe this stock is going to move lower in price. So as an equity investor, I can short the stock. I can short 100 shares at the current price of $100 a share. What's interesting about this is that my max reward now is $100 because if the stock goes from 100 to 0, that's the most I can make. But my max risk here is unlimited. What that means is that if this stock, for whatever reason, either they get acquired or this stock just starts doing really well and now shoots up to 150, 200, 250, the more it goes up, the more I lose. And there's no limit as to how much I can lose when I short a stock. And this is really why I never advocate, if you're bearish on a stock, to ever short the stock. You should consider buying a put option instead. So here, what we have here is the same 1-year put option. So a 2020, again, I'm going to buy an in-the-money put. I'm going to come back in a little bit as to why I'm buying an in-the-money put. And let's say that this put cost me $25. So now what I'm able to do is I have very similar unlimited rewards to the downside that's limited to the fact that it can only go to zero, can't go below zero. So I give up a little reward from $100 to $90 a share as my max reward. But as you can see, the big difference here is that I go from unlimited risk to only $25 of risk. And that is a huge difference between buying calls and buying the stock and shorting the stock and buying puts, is that you truly are capping your risk when you're buying a put option, where as opposed to if you shorted the stock, you have unlimited risk. But just like the previous example, it's not a fair comparison, because if I short the stock and the stock moves down even by a dollar between now and expiration, I make that dollar. But in the put option, I have to consider that my break-even price on the stock is actually $90, which is $115 minus $20. So the stock really needs to decline 10% by the expiration date in 2020 before the strategy is profitable. So I have to believe that this stock is going to move 15, 20, 25% before it makes sense for me to buy a put option on that stock. So again, if that makes sense to you, please type 2 into the chat window. The difference between shorting a stock and buying a put. And I will say, buying the put, I think the best reason to buy a put instead of shorting a stock is to move a strategy from unlimited risk to risking only $25 a share. So mitigating unlimited risk is the primary reason that I think is important to buy a stock. Buy a put instead of shorting the stock, and maintaining the same unlimited downside exposure all the way to zero. So you get the benefit of that unlimited downside exposure, but you don't have the risk of unlimited risk. So just to reiterate, some of the benefits of the strategy is that it gives you similar exposure to the underlying stock, but doing it in a way with limited risk. Now, when you use this type of strategy, these long-dated options, especially with some of the expirations and strike prices that I'm going to line out in the next slide, you're going to usually get about a 3 to 5x leverage over the position. In the previous examples, both the call and the put example, you had about a 4-to-1 leverage, meaning you can control $100 worth of stock with just $25 a share. That's 4 times leverage. Most of these strategies you'll range somewhere in that 3 to 5x range in terms of leverage, while still maintaining that limited risk. Now, one of the main benefits of trading these longer dated options is that you have very low time decay. So you can hold on to, if you buy a 9-month call option or a put option and you hold it for 2 to 3 months, over that 2 to 3 months, you actually have very, very limited time decay. And time decay is really one of the things that works against you when you're long an option. So by buying these long-dated options, if you're holding on to them for 3, 4, even 5 months, you're experiencing a far smaller amount of time decay than if you just bought a 3 or 4 month option. Now, there are some limitations to these strategies. Number one, these long-dated options are less liquid, meaning they're not frequently traded. Some of them may not even be quoted, the really long-dated ones. So be careful when you're trading them. They're not as liquid as the stock, and they're not as liquid as trading some of the front-month options. They also do not receive dividends. So many of times, this is meant as a stock replacement strategy. When you buy a stock, you receive the dividends. When you buy a call option, you do not. So be careful of that. This may be more suitable for those investments in stocks that are not paying dividends. If you are thinking about investing in a stock that pays a nice dividend, meaning anything greater than 3 to 4%, you might want to consider just buying the stock instead of placing a long-dated call. And lastly, they're not available on all stocks or ETFs. But as you can see in the next slide, they are available nowadays on pretty much most stocks, ETFs, and indices. So again, whenever you're thinking about buying these long dated options, you always want to choose an expiration that's greater than 9 months out. Again, the reason for this is because long dated options minimize theta or time decay. And time decay is the thing that works against you the most whenever you're buying an option. Now, when it comes to strike prices, there's a lot of different strike prices you can choose. You can choose at the money, out of the money, in the money. We tend to find that the best value for your money is to buy a slightly in the money call or put, about a 60 to 70 delta call or put. And the reason for this is that in the money puts have even lower extrinsic value. Now, extrinsic value is that time decay factor. The larger the extrinsic value, the more time decay that you have. So when you buy these in the money calls or puts, you actually have lower amounts of extrinsic value, so smaller amounts of time decay. So it really mimics owning that stock while getting about 3 to 5 times leverage. And that's really what you want with these long dated options, is you want to have something that is closely represents the stock, meaning if the stock goes goes higher, you make money. If the stock goes lower, you lose money, but you're doing it with a quarter of the amount of capital. And again, when you utilize this type of strategy, you're going to find that the cost of this call or put option is usually about 15 to 30% of the underlying stock price. Again, around 3 to 5 times leverage is average for this type of strategy. So you only have to put up 15 to 30% of the capital that you would need to buy 100 shares of the stock. Now, again, various reasons as to why you might want to do that. Either you're working with a smaller portfolio and you don't have the capital to buy 100 shares of the stock. You can try to control 100 shares of the stock with an option. Just keep in mind that when you do that, you do have the stock needs to make a bigger move before the strategy is profitable. So there are some limitations to the strategy. Make sure you understand those limitations before you actually start trading them. So to give you a good example of this, what I want to do is, and this is one of the reasons why we advocate buying a in the money option versus an out of the money option, is to show you how it compares to buying that stock. So let's say you have a $100 stock. If it goes down 50 bucks, you're going to lose 50 bucks. If it goes up 50 bucks, you're going to gain 50 bucks. So it's dollar for dollar. It's even. If it goes down, you make a certain amount. If it goes up, you make a certain amount. However, when you buy an option strategy, that's not the same case. So one of the reasons that we advocate that you buy an in the money call option is the fact that you'll see that for the most cases, you end up very similar to the stock itself. So here I have a call option, an 85 in the money call option that cost me 20 bucks. As you can see, when the stock goes down, the stock loses 15 bucks. Here I lose 20 bucks. If the stock is even, I lose 5 bucks. If the stock is up 20, I gain 15. If the stock is up 50, I gain 45. So I'm always just $5 behind the stock position. But as you can see, instead of costing me $100 a share, it only cost me $20 a share. So, and if the stock makes a substantial decline down to $50, I have limited risk. So not only do I have a strategy that mimics the stock very closely, but in the unlikely event that the stock drops significantly, I'm really protecting myself. But otherwise, in all other scenarios, I'm basically performing very similar to the stock at a fraction of the cost to actually own the stock. Conversely, if I bought an out of the money call option, it's going to be really cheap. So instead of costing me $100 a share, only cost me $5 a share. So instead of risking 20 bucks, I'm only risking $5. Now that seems, for a lot of users that are, you learn buy low, sell high, that sounds good, right? You're buying really low. But buying really low sometimes does not give you the payoff that you really want. As you can see, yes, you are limited in terms of losses. No matter what happens, you cannot lose more than $5 a trade. But even when the stock makes a significant move, the stock goes from 100 to 120, a 20% move, you, instead of making $20 a share, you're still only making $5 a share. So even if the stock makes a pretty big move, you're not really making a lot of money on this particular trade. The stock really needs to move a significant amount before you start making some money on this particular trade. So I think of this as more like, almost like, you can think of this strategy here on the right hand side as kind of like buying a lottery ticket. meaning it really needs a big move to the upside in order to make money. In all other cases, you lose a small amount of money. Versus here, in the money call option, what you're going to get is much closer to owning the stock. These two are very similar, but you're doing it at a fraction of the cost. So most cases, people are really looking for something that's, again, a stock replacement strategy. Now, that's not to say that you can't trade the strategy here, but just be aware that when you trade those out of the money call options, the risk profile is quite different, and you really need an extreme move in the underlying stock in order for you to make money. So if it makes sense to users as to why you might want to consider using an in-the-money call option, even though it's more expensive, versus an out-of-the-money call option if it's cheaper, please type 3 into the chat window. Now, if you disagree, if you think that it's better to buy that cheap out-of-the-money call option, please type 4, just so I get a sense for the audience here and what everyone's thoughts are. So if you think it's better to buy this in-the-money call option that's mimics the stock closely, type 3. If you think it's better to buy this out-of-the-money call option that's very cheap, please type 4. Okay, so pretty much all 3s. I don't see a single 4 here. Okay, great. But again, if anyone disagrees, please let me know. I'm always happy to talk about that. So now that we've covered the strategy itself, when should you use it? What expirations and strike prices make the most sense when you're using these long-dated options? Let's talk a little bit about the tips for trading them. Number 1, because this is a stock replacement strategy, you should really think about entering and exit these options the same way when you would consider buying and selling the individual stock. So every one of you is a little different as to how you decide when you invest in stocks. Some of you are fundamental investors, and you look at value and you try to find stocks that are cheap. Others are based on news. Some of you base it on charts. However you decide when it's time to buy and sell your stocks, you should apply that same methodology to decide when you want to buy the option and when you want to sell the option. Now, the one thing that you do have access to, the same way when you buy a stock, is selling a cover call to reduce your cost basis and generate some income. Now, just because you're long an option does not mean that you can't sell a cover call. So it's not technically called a cover call anymore. You're technically trading a calendar or a diagonal, but it's the same concept. You're just replacing the stock leg with a long call. Now, if that makes sense to everyone, please type 4, just so I make sure everyone understands what a poor man's cover call is. What you're doing is you're taking your long call position and you are selling a short-term call against it to generate some yield. So again, your strategy to enter this trade is to enter the trade whenever you have a long-term bullish or bearish view or outlook on a stock or ETF. You always generally want to exit before the expiration date. So this is true regardless of whether you're trading a 1-month call or a 9-month call or a 2-year call. You always want to exit before the expiration date, either at a gain or a loss. And generally, you want to follow the rules that you have when you buy or sell that underlying stock. And you may want to set stop losses and take profits based on the stock price. So if, let's say, you have a $100 stock, and you think the stock is going to go to 120 or 130 sometime over the next couple of years. So you buy a call option. And let's say this stock makes it up to that 120 or 130 level a year and a half in. So what you want to do is you want to set an alert or a limit order so that when it reaches your target, you close out that option trade as well. Conversely, if you think the stock is going to go up to 120, but next thing you know, this stock plummets to 90 bucks, and at that point, normally, if you were a stock trader, you would pull out and get out of that trade. You should also set those stop losses so that you are exiting your trades as if it's a stock trade that's hit a stop loss. So make sure that when you're trading these long-dated options, you really think of it as trading a stock. You're just replacing the stock with a long call or a long put. And lastly, selling a poor man's cover call. And we call it a poor man's cover call because a long call requires significantly less capital than buying 100 shares of the stock. That's where the nickname poor man comes from. So if you can't afford to buy 100 shares, you buy a long-dated call option, and then you sell covered calls on that long-dated call option instead of that long stock. Now, the rule of thumb here is basically the same way you sell a covered call on a stock position, you would sell the exact same expiration date and strike price on that long call. So generally speaking, you're going to sell shorter dated calls, 1 month calls or puts, against that long dated option position. You want the same methodology as you do with the cover call on the underlying stock position. Again, you're just swapping out the stock for the option. And when you do this, on most cover calls, you're usually reducing the cost basis of the stock that you own by on average about 2 to 3% a year when you're selling a cover call. When you're selling cover calls on a long dated option instead, because it only costs you, because you're getting about 3 to 5 times leverage, you are amplifying that reduction in cost basis, usually at about 10 to 15% per year. So you're really significantly reducing the cost of that long dated option when you're selling these short dated calls and puts against that long dated option by a fairly significant portion. And this is really what makes a poor man's cover call fairly attractive, because you can bring down the cost basis of that long call even further. Many times you can completely negate the extrinsic value of that long dated call or put by selling short dated calls against it. But there is one warning that you have when you're selling these poor man's cover call that you don't have the luxury of doing that when you have the stock position. And that is, when on a poor man's cover call, you always have to roll the short call. You cannot let the stock get called away because you actually don't own the stock in order to deliver it. So if you do have the short call exercise, you actually either have to buy the stock to deliver it, or you have to exercise your long call to deliver it. Now, if you have to exercise your long call, you've immediately lost all the extrinsic value of that long call, and that's a loss to you. And you don't want to put yourself in that position. So be careful. When you're selling a poor man's cover call, you always have to pay attention to expiration and make sure you always roll that short call prior to expiration, especially if the stock is above that strike price. So be very careful if you're selling short-dated options on a long-dated option instead of a covered call. So with that, let's jump over to options play. I want to show you some long-dated options and show you, how to compare the two. So for those of you that are brand new to options play, welcome. This tool, again, is available to everyone free of charge in Canada to analyze Canadian securities with. It's a very powerful tool to really allow you to analyze and take a look at different option strategies that do not require you to look at pages like this. If any of you have ever traded options and have tried to figure out which option you want to trade on a page that looks like this, you know that it's not an easy task. It's something that you really have to take a lot of time to learn, to read, before you can even get a sense for where to start. And once you learn that, there's still a lot of work that's required to figure out a starting point and then figure out from that starting point, what is your actual risk? What is your actual potential reward? And what happens if the stock goes up 10%? What happens if the stock goes down 10%? These are all questions that you need to answer before you invest or trade in an option. So we discovered that this process is difficult for a lot of people. So we really wanted to create a user experience that was easier to, number one, get a sense for what strategies should you trade, what expiration dates and strike prices should you start from, and then more importantly, how do you analyze what you've picked so that you know your true risks and rewards before you actually trade them. So the platform itself is designed to answer all of those questions, and you can start off the platform by looking at either trade ideas or watch list here on the left-hand side. Our middle panel is our security analysis panel, giving you a sense for the short-term and long-term trend of the stock. And lastly, trading and income, designed to help you explore and analyze different option strategies so that you can see which strategy is best suited for you. So I'm going to take, I'm going to take a banking stock. A lot of you like to trade these banking stocks. Banking, I actually think, is a fairly a sector that's starting to come back to life. I'm curious as to see if this stock can really kind of rally a little. But let's say you are bullish on the Canadian banking sector, which, it's been pretty volatile over the last couple of years. You've seen some pretty big declines in the underlying stock, but it's starting to move a little higher. So let's say you're bullish on Bank of Montreal. So buying 100 shares of that stock will cost you $9,700. What I'm going to do is I'm going to modify this call option, which is defaulting to a short-dated options for those of you that are more speculative in nature. I'm going to modify this. I'm going to change this to a September 2020. So or maybe an October 2020, almost 1 year out exactly. And what I'm going to do is I'm going to buy an in-the-money call option. Let's say I buy a $92 call. So first of all, as you can see, buying 100 shares of the stock would cost me $9,700. Buying that 1 year call option in the money cost me $800. And if you notice, the break even on this call option is $100 because 92 plus 8 is 100. So this stock really only has to rally about $2.50 over the next year in order for me to break even on this trade. And I'm basically trading this for less than 10% of the underlying shares that I would have to purchase. And the stock only has to move about $2.50 in order for this to be profitable. Now, this doesn't happen very often, but if it does, these options are extremely cheap. I would say this is almost a bit of an anomaly, but this is a very cheap option. So let's take a look. So what I'm going to do is I'm going to use our P&L simulator, which is the tool that we use to figure out how much money do I make or lose on any of these options if the stock goes higher or lower. So let's say the BMO is trading at 97.61. Let's say over the next year, I think this stock is going to rally back up to that all-time high around 106 or so. So I'm going to take a look at my strategy. I'm going to say, what happens if on October 16th, 2020, this stock is at 106? As you can see here, if I had bought 100 shares of this stock, I would make an $828 profit on my $9,700 investment. On my call option, I would make roughly the same, about a $600 profit, but I'm doing it on only an $800 investment. So my return on investment goes from 8% to about 75%. That is the nature of buying a long dated option. And now again, this option is particularly cheap. As you can see, I'm getting almost more than 10 times leverage on this trade. That's fairly uncommon in my opinion. Usually, like I said, you see about 3 to 5 times. So this is a particularly cheap option. The stock doesn't need to move very much. In my opinion, this is a very compelling trade if you are long-term bullish on Canadian banks. And I bet if you look at other banks, you probably find something similar. Let's take a look. Let's look at Royal Bank of Canada, trading at 107 right now. This stock is near its all-time high. Maybe you think the stock can actually break out. Maybe if you do think the stock can break out and maybe buy a 100 strike call, as you can see, it cost me $9 to buy a 100 strike call going out to October 2020. So again, this is less than 10% of the cost to buy 100 shares. And my break-even price on the stock is 100 plus $9, which is 109. Only about $1.70 from the current price. So this stock only has to rally about $1.70 before this strategy becomes profitable at expiration. So if the stock does rally and break out to all new highs, even if it just makes a modest move to 112 by expiration. As you can see here, what I'm making is about roughly the same amount of profit. I'm making $468 when I invest $10,000. I'm making $300 when I only invest $900. So that amplifies my return. That amplifies my return from $468 to 4.36% to 33%. And I think what's more important is that what happens if the stock declines? And I think that's a big if. Because these stocks are at near all-time highs. These have traded as low as $98 just a couple of months ago. So what happens if I'm completely wrong and the stock plummets? Notice how the difference between these two are almost identical in terms of losses. Here I lose $932. Here I only lose $900. Now this is if the stock declines to 97, 98, which is certainly possible. But what I'm really concerned about is maybe a correction back down here to 90. So if it does happen here I'm losing $1,700. Here I'm still only losing $900 because when I buy a call option, the most I can lose is the amount that I pay for that option. No matter what happens, I cannot lose more. So many times when you're near all-time highs and you think that there's going to be a breakout, but you're concerned about a larger pullback, a call option gives you that upside leverage with limited risks to the downside. And you can even get a little bit more aggressive. You can maybe buy a 105 call. This puts the break-even price a little higher, around 110.70. So the stock needs to move about $3 higher before this needs to break even on this particular trade. But as you can see, if the stock declines even down to $89, you're losing substantially less. Or I'm sorry, what was that previous low here? 104 or no, 97. If the stock declines to 97, here I'm losing $1,000 on the stock. I'm only losing $570 on the call. So you can make these adjustments on your own based on how bullish you think you are on the trade and how much risk you're willing to take. But options play not only allows you to find your starting points, but more importantly, analyze those trades so that you know what your potential risks and rewards are before you get into a trade. Lastly, I'll do, one more example. Maybe let's look at some marijuana stocks. Stocks have taken a huge tumble over the last year or so. Maybe you want to invest long term, but you're really concerned about potential downside. Now these are much more volatile, so I expect the options to be much more expensive. But let's take a look at this. Let's go out to January 2020. Let's say I buy an in-the-money call. Let's say I buy a $25 strike call. So if I buy a $25 call, as you can see, it cost me $7, which means my break even is $32. Now, $32 on this particular chart is right here, right? Which is where it was here just in September. Now, granted, there's more downside probably to the stock before it can rally, but as you can see, that's not a huge ask for this stock to move up to $32 by January of 2021. That's more than a year from today. So what you can do is you can basically protect your investment. So this is $700 out of $276. This is much closer to the type of leverage that I'm talking about. You're talking about 4-to-1 leverage, a little more than 4-to-1 leverage, just about 4-to-1 actually. So you're controlling 100 shares of stock for $700 as opposed to $2,700, which means that if the stock does rally up to, let's say, 32 or 36 over the next year and a half, you're looking at a 57% return instead of a 30% return on your underlying stock. If you do get a bigger move, you're going to see a higher leverage. But I think more importantly, if the stock does decline, and I don't know how far this can go, but this trend does not look pretty. It's broken some major support levels. It's still got one more left around 25. If this does break 25, I think this can move significantly lower, maybe even down to 15. This is really about controlling your losses, being able to invest in the long term while controlling the risk that you have to the downside, so that if these types of industries, this could maybe go bankrupt by 2021. You don't know. I think you have a higher risk of an industry like this or a company like this going to zero than some of the banking stocks, right? So I don't think I'm not too concerned about Bank of Montreal going bankrupt overnight. But some of these newer operations in an industry that's fairly new, you never know. So especially if you're investing in the long term in marijuana, you might want to consider taking a look at some of these leap options as opposed to buying the underlying stock, especially on stocks that don't pay any dividends. And these are prime examples. Some of those banking stocks pay dividends, so some of them pay very nice dividends. So you miss out on those dividends. On these high-flying stocks like marijuana stocks, you might be better off buying that call option because you're not getting the dividends anyway when you invest in the underlying stock. So with that, that sums up what I wanted to show you guys here today with, what are leap options, what are the best practices for selecting them, and more importantly, how can you utilize options play to how can you use options play to analyze and make sure that you understand your risks and returns on these types of investments. So with that, I want to thank everyone for taking the time out here this afternoon. I hope that this was useful in helping you guys understand not only the strategies, but also the platform itself. So at this point, I'll open this up for Q&A. If you have any questions, please type them into the chat window. And again, if you do not already have access to Options Play, please sign up using the link that I just posted in the chat window to help you get access to this free and powerful platform courtesy of the Montreal Exchange. So thank you so much. Let's go look at some of the questions here. Jeff asked a question earlier. I did register, but did not get a verification email, so I'm unable to log in. So Jeff, if you don't mind, send me an email at info@optionsplay.com, and I'm happy to look into that for you. I just need your email in order to do that. Let's see. What does it mean when the Options Play logo appears next to a trade? So that was by Claude. Claude, do you mean here in the trade ideas list? Is that what you mean? If you can answer that, I'm happy to answer that question. Debbie's saying, can you please explain the Options Play score? Okay, I'll get to you in 1 second, Debbie. Claude just answered, yes, he's referring to the Options Play logo next to the trade idea. So what this means is that Hudson Bay, in this particular case, met both the CCI bullish scan as well as the William %R bullish scan. So it triggered 2 scans for today. That's why it gets that Options Play logo. So that's what the Options Play logo next to a trade idea means. Debbie's asking, can you explain the Options Play score numbers in the colored circles? So the Options Play score basically tells you what is the potential for reward on this trade versus the potential for risk. And as you can see here on this particular graph, because of how expensive this option is, you have very little opportunity to potentially make money, meaning the stock needs to move a significant amount and you're still only making 37% return. But if the stock declines, you have a lot more opportunity to lose money on this particular trade. And even if the stock goes spectacularly in your favor, you have limited amounts of money that you can make. That's why you get a really low Options Play score. Compared to that first example in BMO, the options were really, really cheap. The stock, even going out to this October 2020, buying an in-the-money call cost only $800, a very, very small premium. So you have a lot more opportunity to make money. So if the stock moves a little bit, you can still make a significant amount of return. And if the stock makes a big move, you have a very large percentage return. That's why it has a much higher Options Play score. So it's really a risk to reward ratio based on the price of the option, letting you know what is your potential for reward. The higher the Options Play score, the more potential you have of making money on that trade. The lower the score, the smaller the potential that you have of making money on that trade. Azim is saying, can you show a put on weed? Sure, let's take a look. So Azim, on the other hand, says, well, why don't we look at some short opportunities on this? So let's take a look. Shorting 100 shares, let's buy a put option. I have an inkling that these put options are going to be really expensive. Yep. So as you can see, buying even an at-the-money put going out to January 2020 will cost you, $850. So a substantial amount of capital required. So as you can see here, on an $800 option that has a strike price of 28, that puts your break even at around what, 15 bucks or so? 1850, sorry. Puts your break even at 1850. So you have to ask yourself, do you think by January 2020 this stock is going to be below 1850 or not? If you believe so, then this put option will at the very least break even, but you really have to believe this stock is going to go down to 15, maybe even 13 before you make any significant capital. 18 is just the break even price. So if the stock goes down to 15, notice how the stock goes down to 15, which is almost a 50% haircut from the current price. You're only making a 48% return. So that just shows you how expensive these options are. And that's why you have a relatively low Options Play score, because these puts are expensive. So ask yourself, how bearish are you on wheat? If you're extremely bearish, then it makes sense to buy a put. If you're not as bearish, I wouldn't go near this. Claude is saying, when do you feel it's better to sell a put? You should only sell a put if you want to buy the stock. So that's a completely different strategy. We have an income tool for that. So if you want to buy in Canopy Growth, selling a put is a great way to potentially buy this stock. So Claude, I actually have a whole webinar just on that alone. If you want to see that, please go to our YouTube Options Play Canada website, and that will get you access to, whoops. So I'm going to send the link to everyone to our YouTube channel in Canada so that you can take a look at our videos. And I have one specifically for enhancing your equity positions by selling cash secured puts. Can you do a poor man's covered call in a registered account? Good question. I'm not 100% sure, JM. But that is a question that your broker would be able to answer. And the question is, can you trade either a calendar or a diagonal in a registered account? My understanding is a lot of registered accounts do not allow you to trade spreads. So if you cannot trade spreads, then I don't believe you can trade a poor man's covered call. Jeff, you're very welcome. William saying, why not buy a really deep in the money call? Well, there's really no reason to. You're just paying more and not getting as much downside protection. So there's a balance between, yes, you want to decrease extrinsic value, but when you go that deep in the money, you're not really decreasing the extrinsic value by much more, and you're paying double the price for that call option. I don't find that that's really useful. So 60 to 70 delta is usually as far deep in the money as I will go. Daniel asked a question, what's your opinion on selling a cash secured put that covers an earnings date? I generally try to avoid selling going into earnings date. You do get a little bit extra premium, but you also get that huge risk of owning the stock significantly lower than the current price. So, I mean, if I'm selling going into earnings, I would simply sell a put that's further away from the current price. What is the highest score level? The highest score level is 250. Does the software come with a manual? So, it doesn't come with a manual, but we have a whole YouTube channel on teaching you how to utilize our tool. And you have a guide button here at the bottom of your screen. So if you click on guide, it pops up all these little pins so that you can understand what things are on each screen. So those are the different services that you can utilize in Options Play to help you learn about this platform. William, where can we find the meaning of the symbols such as checkmark or Options Play logo? So that's where the guide comes into play. So you can click on the guide and you can hit different trade buttons and you can look at what the Options Play score is. So I highly recommend you to use the guide tool for that. Claude clarified, said you cannot sell in a registered account. Thank you, Claude. What would be the strike of the cover call? It would be the same strike that you would sell a normal cover call on. It doesn't matter whether you own the stock or the call option, you would sell the same strike. So that's where you can use the income tab to find the cover call strike to sell on your poor man's cover call. Azim said you can only buy calls and puts in and cover calls in a registered account. So you cannot sell a poor man's cover call. Lewis, the U.S. service is for U.S. stocks, so it's a completely different service. It's not like you're getting it for free. The Canadian version is free, but it's limited to only Canadian options. Long put options, also called a LEAP. So LEAP is actually a trademark in the US that doesn't exist in Canada. So yes, in the US they call them LEAPs, but that's a trademark name that doesn't exist in Canada. Any other questions? If there are no other questions, I just want to thank everyone for taking the time out here this afternoon. Lewis, yes, the slides will come with the recording when I send them out in about 30 minutes. So please look out for that. For those of you that want to follow along, you can get both the recording and the slides so that you can learn at your own pace. So thank you so much, everyone, for taking the time out here this afternoon. I really hope that you guys have found this useful as an alternative to potentially owning some stocks or investing in some stocks. So And I hope that this taught you a little bit about how to use options play. So with that, thank you so much. I hope you guys have a great evening, and I'll see you on the next webinar.